In this video, I'm going to break down for you the concept of a range and how this is one of the easiest and most profitable patterns to trade. It works on very low time frames all the way up to high time frames. So this is perfect for day trading, for scalping, but also for larger term swing trading. And it is very helpful to know how this works. So make sure you smash the like button, subscribe to the channel if you haven't done so already, and let me dive straight into it. Real quick, before we get into the tutorial, if you're looking to trade cryptocurrencies, whether it be spot trading or futures trading and leverage trading, personally, I use Bybit Exchange. Currently, they have a campaign where you're able to get up to $30,000 in deposit bonuses if you don't yet have an account. So click the link in the description down below. It's the first link in the description. Sign up for the Bybit account. And as you can see, the campaign here in front of us, it shows the possible bonus structure for deposits and trade volumes. It's a very good deal. I personally use Bybit Exchange for both spot and crypto trading. I found them to be very good, very efficient. They have a great mobile app. So if you don't yet have an account, click the first link in the description down below, sign up, and you have the possibility here for this cool deposit bonus campaign. Okay, so let me break down the concept of ranges, and it is actually a very easy concept. Once you understand how this works, you can see it over and over again on all sorts of time frames, and it is really a very efficient way to trade and a very profitable way to trade because it makes finding invalidations very easy. You know where to enter, you know when you're wrong because you know your invalidation, and if you're right, there's a good potential for it. And most of the time, markets trade in ranges, okay? The time when it trends, when it has these crazy up moves or down moves, is a lot less actually than the time percentage-wise that the market moves within certain ranges. So understanding how to trade ranges and understanding what they are is going to be very beneficial because a lot of the time, more than 50% of the time, the market trades in these ranges, and that can help you just be more profitable. So what is a range? Well, it is a very well-defined level or an area between two levels in the price where the price action moves up and down between that until eventually it breaks out. So as you can see over here, this is a nice example here of a range. This is just a 4-hourly chart on Bitcoin random point in time. Just as an example, I'll show you more examples in different time frames how this works later in the video. But how this works is very simple. As you can see, for this whole period of time, which in this example is, let's see, that's about 2 weeks that it's spent trading within this range, within the range of 16,700 to 17,400. Now, most people get absolutely chopped up within the range because a lot of people, it's easy to make money when there's a trend, right? You can jump on the trend, you can long, but then the market ranges for 2 weeks. There's no more trend, and people who don't have a system, who don't understand trends, what they tend to do is they tend to just long tops and sell bottoms, the exact opposite of what you should be doing. Now, the number one rule with a range is that you do not want to trade in the middle of the range. That is when you get chopped up the most. What you want to do is you want to trade the extremes of the range because it gives you the highest odds of making profitable trades. Now, of course, it is 100% certain that at some point a range is going to break, okay? So the rule is you trade the range until the range eventually breaks, which means you can get multiple profitable trades within a range until at some point it gets invalidated, okay? So how does this work? Well, you can see over here, we take the extreme of the low over here on this wick and the extreme high over here on this wick, okay? At this point in time, that defines our range. Now, what we are looking for, what almost always happens, is that both the low and the high of this range get taken out. That is just how these markets work because people who are shorting after this pull back down, they put their stops right there, they get taken out. And people who are longing here with this market here, they put their stops right there, and then we wick below it. As you can see over here, we got the wick above this high and we got the wick below over here. So it's taken out both sides of the range. And these are the points where you want to look for entries because that is what we're expecting. That is basically the rules of the range. Once you define the range in the beginning, you don't want to trade anything in the middle over here, because that is where you get chopped up. You're guessing, where is it going to go? Long, short, especially if you're doing high leverage, which a lot of people do. They try and trade this chop. They get stopped out like 10 times. They give back all their profits that they made from this breakout over here. Maybe they were longing it and they get euphoric and they're thinking, hey, I'm going to continue trading. But then it just ranges sideways for 2 weeks. And you get absolutely chopped up if you trade in the middle of the range. So the rule is you establish the range and you simply wait. You wait for a sweep of the high to take a short position or a sweep of the low to take a long position. And in this case, obviously it went to the high first and went to the low. We don't know, right? At the point when you define the range, you don't know what it's going to take first. Maybe it takes the low first and you can long first. Or maybe it takes the high first and then you can short first. So the idea is to be able to take positions on the sweeps of the range at the extremes of the range. So like I said, you don't do anything in the middle. You wait for either that sweep of the high or sweep of the low, and then you are prepared to take a trade. Now, obviously, in this case, it is a 4-hour chart. It can be a daily chart. It can be a 3-day chart. It can be a weekly chart. It can be a 5-minute chart. Okay, and obviously, the amount of time spent in the range will depend on the time frame that you're looking at. So in this case, it's a 4-hour chart. So we can spend 2, 3, 4 weeks within a certain range. Obviously, if you're looking on a 5-minute chart, that's going to be maybe days or hours within a range. If you're looking on a weekly chart, that could be months or maybe a year or 2 years within a range. Okay, so it all depends on the time frame, but the concepts remain the same. Now, of course, we don't know at this point in time if this sweep over here is going to end up being a breakout where it just continues higher. That is, of course, the risk. Now, the nice thing about this is that your invalidation is pretty low, and you want to look for a confirmation, ideally, of a pullback in the range before shorting. Okay, so at this point in time, when the candle is over here, obviously it pulled back before the close, but at this point in time, you don't know. So you can't just go and blindly short at this point, because we don't know where that wick is going to stop. Maybe it wicks way higher. You can't just short while it's still pumping there. Okay, so we can have the expectation, and then the idea is to take out the range low. So you can see the risk reward here becomes really interesting, but we can't just randomly take that trade. So ideally, what you want to do is you want to look at a lower time frame for an entry over here. So we have defined this range. We know what we're looking for. Maybe we go down to the hourly chart. Even better, maybe the 15-minute chart. But let's take a look at the hourly chart. So let's zoom into the 1 hourly chart, because it gives you a better point to look for entries. And as you can see on the 1 hourly chart, we got the wick above there, and you wouldn't just randomly buy over here as it's pumping. So we wait for the pullback, we wait for the close. And even at that point, we can start to say, okay, well, things are interesting, and maybe we just enter because it pulled back and it closed back into the range. But what we can do is we can look at even smaller time frames. So we can go and look at the 15-minute chart to really get an ideal entry at that point in time. So now we're zooming into the 15-minute chart, and you can see it gives you a much better insight into what is happening, and you get a higher chance of being able to enter with more precision and more accuracy. So we have our alert set towards the top of the range. Once it starts getting there and we get alerted, we can start looking at the lower time frames, like for example this 15-minute chart. Okay, so we're not doing anything, we're not buying on this breakout. This is what a lot of retail traders and retail investors do. This is obviously what a lot of these YouTubers talk about. We get these wicks to the upside and everyone's like, oh, it's breaking out, let's long it. And a lot of people long it right at the top, which is the exact wrong thing that you should be doing. You should be looking to short a sweep of the range high over here. So at this point in time, we get the wick above it, we pull back into the range. And at this point, we can already start to take a short position over here. Even if it's a little bit over here, we can set the stop a little bit above that wick, because in theory it should hold, and we're looking to target the range lows. And you can see the ROI on this is huge if you're right. If you're wrong, you lose 1 R. So when it comes to trading, especially day trading or scalping, doing anything with leverage, strategy I like to follow, and I think it is the best rule, is to simply risk only 1% of your trading account on a single trade. Meaning, if you have a $10,000 account, you're only risking 1% of that on your trade, which is $100. The reason for this is simple. You want to protect your capital. If you're wrong, and in trading, you know, everyone is wrong, you take losses, that's okay. If you only lose 1% when you're wrong, you can lose 5 or 10 or 20 trades in a row and still have the majority of your capital to be able to make that back. Okay, so the biggest mistake people make with trading is just over risking and losing a large part of their account on a single trade. As long as you don't do that, you have plenty of room to make mistakes and continue to learn. Okay, so in this example, it's a 1 to 6 risk reward, meaning that if you're wrong, you lose 1%, but if you're right, you make 6%, and that obviously all adds up in a big way. So you can see over here, the idea is, okay, we get a sweep of the range high, and then after that, it traps people, if this is indeed a range, if it's not a breakout, okay, traps people, and we go and sweep the range low after that, which is exactly what happened. You can see it takes time. So I will play this in replay mode in a second so you can see it in real time. But this is basically the trade. And then the cool thing is over here is we can do the exact opposite. So this is a trade over here. Now we were expecting the range low to get taken out. It did. And in that same way, we just got that 15-minute wick below it and it pulled back up. So at this point, you can expect the opposite once again. And it's possible here to take another trade where we take a long. So let's say it pulls back up. We can take a trade over here. We put that stop just a little bit below that wick, and the target would once again be the range high over here. So you can see that's in this example here, that's a 1 to 4, maybe 1 to 4.5, but let's say 1 to 4 risk reward, and that's simply because we're entering a bit higher up after that wick pulled back. And the reason for that is we just want to be a bit safe with the stop. We don't want to put it too tight. So you can see what happened here. It came back down on a 15-minute wick exactly to retest the range low once again. That exact level over here, it retested. But that's perfectly okay because it is within our stop, right? So that's perfectly okay. And then what are we looking for? We are looking to target that range high. Now you can see over here, it didn't quite get there, but that's okay because even though it didn't get there initially, eventually it did hit there. So if you were managing this trade and you were looking at it, you could potentially see this on a lower time frame, like 5 minutes, and you might be able to take some profits here on a 3R or whatever you want. Or, you know, you can also stick to the trade if you're willing to hold it. You know, at this point, you can move stop to break even because it shouldn't get back there, and then just simply wait, and eventually we got that breakout to the upside target hit. So this range perfectly gave us 2 trades here, short and long, for a total of 10R, 10%, by only risking 1% of your trading account, right? So you could have had, if you have a $10,000 account, you risk a maximum of $100, and both of these trades could have given $1,000 profit on your 10K account, which is a 10%. That's huge, just from 2 single trades. And you can see this is how these ranges work. And eventually we get the breakout. Now that could be to the upside, it could be to the downside. In this case, it was to the upside, and you can see over here at this point we wouldn't take another short once this trade got hit, because what we see here, which you can see, is we closed above the range. Okay, so if we don't get back into that range itself after sweeping above it, it's invalid. And besides that, we've already had a sweep of the range high, sweep of the low, so basically the range is completed. We're looking for 1 sweep of each. Sometimes it does stay in the range more than 1 sweep, but in general that's what you're looking for when trading ranges. And then obviously at this point at the breakout, this range is no longer valid, and we look for potentially the next range to start forming after that. So here's another example of a range. You can look on these charts, you can find it over and over and over again. So what we're looking to do over here, we identify the range from the wick low to the wick high over here. Okay, and at this point we don't know what's going to happen. We're looking for either a sweep of the highs or a sweep of the lows to be able to take either a short position at the top or a long position at the bottom, and we don't know what happens. So we set an alert just before these range extremes, alert at the top, alert at the bottom. That way, if you're not at your computer, the alert goes off, and then you can go and check on a 15-minute, on a 5-minute chart. So in this case, we got a sweep of the high over here, And again, we're not looking to short this while it is pumping. We're looking to wait for a sweep, pull back into the range, and ideally on 15-minute or 5-minute, gives you more precision when that happens. Okay, it pulls back into the range, and then it's possible to take a short position to target the other end of the range, which in this case would be here at the bottom, and you would take a stop just above that wick. So obviously you would zoom in on lower time frames once you got that confirmation, and you can see here that can be a huge risk reward. In this case, 9R, maybe it's 5R, 6R, 10R, but that's very, very big. So when you're wrong, you lose 1% of your trading account. When you're right, you can make 5, 8, in this case 9%, right? So these trades are very, very profitable in terms of setups, and that allows you to take them, because even if you're wrong, like on a 9R trade, you can be wrong 3, 4, 5 times in a row and still be incredibly profitable if just one of those 9 works out to be a 9R. Okay, that's how powerful this strategy is. So we got the sweep, we hit the bottom here, we got the sweep of the range. So again, we're not looking to short this when the range breaks down. That is what a lot of people do, and that is how they get wrecked, because they short the bottoms and they long the tops. Okay, the exact opposite of what you should be doing. So now that you know that this is a range, once it hits your target here, obviously a very profitable trade, we're not looking to short this, and we're looking to see, again, is this a wick down or is it a complete breakdown? And that is why you don't want to anticipate this, because in the event that it does break down, it's possible. If you're trying to long this without confirmation and you're longing this, you're just going to get wrecked. And you can't just randomly take a long position and put a stop, because you don't know how deep this wick is going to be. Does it stop here? Does it stop here? Does it stop here? And pull back. So what you're looking for is a sweep of the range low. And before you take a position, you want that to pull back into the range. So even on the hourly, you can see it's just a wick and the body closed within the range. We got another wick over here. And if you were to zoom in on the 15-minute chart, you could probably take an entry somewhere around there. So I can't really zoom in right now because it's too far back in the data and it's just not going to load for me. But let's just say, even if you were to take a trade over here, okay, very safe on the hourly chart, you put a stop just below the wick and you target the range high. Again, that is a 1 to 2.6. That's really not the best risk reward. That's why you want to look at the 15-minute chart or the 5-minute chart to get those better, more precise entries, because you can see it makes a huge difference where you enter. Compared to the short, that's a 1 to 9. But here, because you're entering so much higher and your stop is so much wider, you're only getting 1 to 2.6, and this makes it much harder to take these trades, because here you have to be right at least 50% of the time to be profitable, whereas here, you know, you have to be right less than that to still be very profitable. And as you can see, this trade also ended up holding, but it went up, came back down twice to wick below the range low, but eventually it ran up to the highs over here. And over here again, you don't want to be taking a long trade on this breakout. That's what a lot of people do. They see this big green candle and they're like, okay, we're finally going to the upside. Look what happens the next candle, all the way back into the range. And you can see over here, this range is actually playing out a lot longer, where most of the price action is still in here, but we have this crazy wick above it, we have another wick above it, and another wick above it, right, as you can see. So again, there is possibility to trade this here, but ideally, what I like to do in terms of just a rule is you define your range. Once you get your sweep off the top of the range, that's a short. You get the sweep of the bottom, that's a potential long, and after that, you can still try and trade this range after that, but I think the first two trades, once it's swept the highs and the lows, just be patient and wait for a new setup to develop. That's probably your highest probability, because otherwise you get this trickery where it went up and below, and if you're trying to short it again, it doesn't hit the range low. And maybe it will hit that range low again, but you can see it gets too tricky with these wicks now and this price action. So we got two really nice trades from this, and we can be happy with this kind of trade. So what I want to try and do for you here is just run through that in real time, in replay mode, so you can see how this works. And then the best thing that you can do is just go and test it for yourself. If you have a TradingView account, go and find these examples on Bitcoin and Ethereum on different charts. You will be able to find ranges and see how it works. And then test your knowledge, test your skills, before you start trading with real money, test the replay mode, okay? It's not 100% the same as doing it in real time before you know what's going to happen, but it is the next best thing that you can get to practice this. And like as you're watching this right now, you don't know what's coming ahead here, and even if you saw it before the time, usually you don't remember the exact candles and stuff like that. So it is pretty much as close to the real thing as possible. So what we do is we do this replay mode and we just see what happens here. You can run it through candle by candle over here manually yourself. Okay, so we get these wicks like this, and we can see, is this going to be the range? So let's define that range over here. We take the parallel channel. It is the easiest way to do it. We take it from the wick low over there, we hold down the shift key to get it nice and parallel, and then we get it to the wick high over here. Okay, so we had the wick here, we had the wick here, and we're looking for this range to develop. So what we're looking for now is we are looking for either a sweep of the high or the low. If we sweep the high, we're looking to take a short position. If we sweep the low, we're looking to take a long position. And then what we are looking for, we don't just blindly enter on a break here because we don't know. This could continue going higher, it could come down, it could go all the way down. So what we're looking for is a sweep just above this, a little wick, and then a pullback into the range, and then a test of the opposite side of the range. Okay, that is how it works. So ideally we want to set an alert somewhere over here and somewhere up here so that whatever happens we get notified, and then we can look at the lower time frame. So for example, we can go and look at a 15-minute time frame to see what happens. Okay, so let's just continue. Let's actually see if we can zoom into 15-minute chart over here. Let's see how this continues to develop. We don't know at this point, is it going to sweep the highs first? Is it going to sweep the lows first? Okay, so we let it play out. We got our alert set. Nothing is happening. We do not trade in the middle of the range. That is how most people get wrecked because we don't know. Is it going to go up? Is it going to go down? If you take a position here, it is just not a good risk reward because you don't know where do you put your stop, right? If you're trading here and you're trying to short, you're going to put your stop up here, which is a very wide stop, and it makes the risk reward not great. So do not trade the middle of the range. Let's see what happens over here. It still has not swept the high or the low. We're not doing anything yet. Okay, we let it develop. At this point, our alert probably went off, but still we do not have a sweep yet. Okay, so now this is interesting. Now we got a sweep and we pulled back over here. So ideally we want to see what happens the next candle. Let's see what happens. Okay, we go up here, and at this point we're looking for maybe failure over here. So let's see what happens. We can zoom in a little bit even more at this point. Okay, so we can zoom in on the 5-minute chart here to see exactly what happens. And here that was a nice wick. We got a retest over here of this level. So ideally what we're looking for, let it continue one more candle or two more candles. Ideally we want to see some sort of failure here, and I think at this point I would probably be willing to take a short position and test this out and basically say, okay, we got the sweep of the highs, we pulled back in it, we got a retest over here of this level. Let's put a stop over here and we target the range low, which it should also sweep. So again, at this point in time, we got a 1 to 4 risk reward over here, which is pretty nice. Okay, it means we can be wrong 3 out of 4 times and still be profitable. Okay, we can be wrong 75% of the time with the setup at this point in time and still be profitable. So you can see, okay, let's see what happens. Okay, so you can see how long that took. That took forever because it's on the 5-minute chart, so obviously I sped that up for you. But you can see how many people get chopped up because it stays in the middle of the range. And every little move, people are scalping this with high leverage and they get stopped and they get stopped and stopped and stopped. And they lose so much money in these ranges. So you can see that perfectly worked out. It swept the lows over here. Our target got hit. And in this case, it was a nice 4.4R, so 4.4%. Now, as you can see, it makes a huge difference where you get in and where you place your stop, okay? Because I got in over here. But if you were paying attention to the 5-minute chart and you try and get in as close to that range high as possible, but you need the confirmation of the pullback into the range first, okay? Because otherwise it could continue up and it might not be a range. So do not short it before it has actually swept the high, okay? That is the key range, and vice versa at the bottom. Okay, so we got the sweep, we pulled back into the range. We often get a retest, but you don't always get a retest of the exact range high. In this case, you didn't. So if you're waiting for the range high to get in, you might miss that. So sometimes you might get in a little bit earlier, which changes the risk reward. Obviously, you can make the stop a little bit tighter. You can make it the exact high and you can try and get in. And obviously, the more precise you are with your entry, the higher the RR. This is literally double the RR. It makes it 8% instead of 4%. But if you're doing this, obviously your stop is a lot tighter and you're going to get stopped out more often. So if you're trying to get the best RR and you're willing to get stopped out 1 or 2 or 3 times to do that, then maybe that's okay because you still get a bigger risk reward. Let's just say you try it like this and you're aiming for an 1 to 8 risk reward. Even if you get stopped out 3 times and eventually the 4th time you get it, you're still making 5R. Versus if you get a 4R on the first time, you know, you're making only 4R. So there is a difference with this and you can play around with this a little bit depending on your style. But okay, you got the first sweep over here. And now obviously we can do the inverse. We can try and look for a long position now because we got the sweep, target got hit. And now we can say, okay, we're probably going to go back up to the range high. So we're going to look for an entry, if possible, somewhere as close to the range low as possible, a retest and a stop below that low. So at this point in time, even though I kind of know what's going to happen, I don't know the exact wick, I don't know how deep it's going to go, etc., etc. Okay, so we got the wick low. What we're looking for is maybe an entry towards the bottom of the range, and this is purely a guess at this point in time. Something like this is what we're looking for. Okay, let's see if we can get that. That's a 1 to 8. Again, that stop is pretty tight, so it is possible that it gets stopped out. We can also go a bit wider and basically say like, okay, well, you know, it's 1 to 4 now, but now the chances of getting stopped out is a lot less. So it's really up to you what your style is there personally. And I'm just going to change this back to a 15-minute chart so it actually goes quite a bit quicker than what we're seeing here right now. So let's just let it play and let's see what happens over here. So we got the entry right there, as you can see. That's perfect. So as you can see, the target got hit over here, and even though it did sweep into that range low again, the stop loss held. That's why we want to have it under the stop. You can see this was a very testing one, but eventually it worked out. So we got a 4R initially, we got another 4R, that's an 8R for 2 trades from a range. I showed it to you also in the replay mode, and this just works over and over and over again. Again, there's no guarantee that every single trade is going to be a good one. You don't know for sure, but if the risk reward is 4 or 5 or 6 or 7 or 8R or even more than that, you can take it and get stopped out a few times and still be profitable. This is a very high probability trade. So what we're looking for, we establish the range, we look for a sweep of the high and the low, a reclaim black into that range. Okay, so be very careful. Do not breakout trade this, do not anticipate it. Wait for the sweep, wait for a pullback in the range, and then you can take the position, and the target is the opposite side of the range. Vice versa, you don't know if it's going to go down first or up first. Either way, you can be prepared because once it does the initial sweep, it usually goes to the opposite direction. If you found this informative, subscribe to my channel, smash the like button, share it with some friends and family, And if you want to learn more from me, I got a complete trading course, a trading community around crypto. It is my VIP membership, the second link in the description down below. Come and check that out. Come and learn from me if you enjoyed this kind of video. And if you want to trade, if you don't yet have an account with Bybit, I highly recommend it. I personally use it. There's up to $30,000 in deposit bonuses. Obviously, terms and conditions apply, but it's a great place to trade spot crypto, futures with leverage. They got a great mobile app, and you can get all of that. Create your account through my referral link, the first link in the description down below, and claim those deposit bonuses. Thanks for watching. I will see you in the next video.